Okay, in this one, we're going to go through our philosophy on VSL acquisition and more specifically, essentially how we think about scaling any agency or coaching type business to $1 million a month. And I really do believe that the reason why we have the best client results in the space, we've also ourselves scaled our agency past, all there's a lot of agency gurus out there and whatnot, but most of them haven't scaled past 100, 200, 300K a month with a done for you agency type business model. We have, and I put it all down to our philosophy on how we think about scale. This is where I'm at right now. I don't do anything other than just lead my team and we generate clients. When we generate those clients great results and we have a great back end, etc. And I don't do I'm not the one doing the thing, right? And essentially what that then bleeds into is an asset that runs on complete autopilot and is entirely detached from you as the founder. As I say, I could go away tomorrow and everything would still run perfectly, to be honest. I mean, eventually some things might break because of QC, over time might break. But again, I could go on holiday for a month and nothing would break, nothing would happen. And if anything, we'd just continue to scale, right? But it's because we have an asset that runs independent of me. It's not attached to me. Our client results, client delivery, client fulfillment isn't attached to me. Our ads aren't attached to me anymore. And you will have the same thing. But again, this is once the VSL is dialed in and your sales team is dialed in as well. This is once those two things are dialed in. Now, to get to that point, you will need to put in some upfront effort, especially on the sales side, particularly on the sales side, to be honest. But again, it's like, yeah, you need to put in some upfront effort, but then this is an asset that will take you to 8 figures. I'm going to show you the math behind it here in a minute, but that's how you got to think. Like, yes, it's going to require some upfront effort, but it's also going to be something that's going to take you to 300K a month, 500K a month, or $1 million a month, depending on your starting point. Obviously, if you're at 10K a month right now, I'm not saying you're going to get to $1 million a month, at least immediately. But if you're at 500K a month, this is going to be the thing that will get you to $1 million a month, no problem. If you're at 100K, this is what's going to get you to 250, 300K a month, no problem. If you're at 10K, this is what's going to get you to 100K, no problem, right? So I just, again, wanted to make that clear. Now, here's I call this the VSL death trap because it's alarmingly common. And it is literally a death trap. So I'm a very non-emotional person. However, there's one particular scenario that always eats away at me whenever it happens. And it truly eats away at me. And it's more common than you'd think. So there's one scenario, but there's like kind of 2 variations of that scenario. So scenario variation 1 is the ads and your VSL is working. They're generating sales calls. Some are qualified and some are unqualified, which is always going to happen. Again, this is going to be based on niche and revenue. So it's like, are they in the niche? Do they have the revenue that you need them to have? And obviously, do they have the problem that you solve, right? And again, some are qualified, some are unqualified. And we cancel the unqualified. And we have a cost per book call that then remains, cost per qualified book call that remains in KPI. However, what then often happens in this instance is the client is unable to close the calls due to a lack of sales ability. And so in their mind, quote, the VSL doesn't work, right? This is, again, alarmingly common. And just on this bit here, to put this into perspective, we have a client, this morning was speaking on a client, and they are currently getting in the ad account a $60 cost per booked call total, not factoring in qualified versus unqualified, whatever, right? And roughly, I think about 40% or so of them, of the bookings that are coming in are unqualified, again, based on niche, revenue, and the problem that they have, right? And so call it 50% easy numbers. So that then puts them at $120 cost per qualified booked call, right? Then if they have a, say, it's not this bad, but they just say they then had a 50% show rate, that would then put them at a 240 cost per qualified live call after canceling unqualified and factoring in show rate. Their cost per qualified live call is 240 in that instance. That's a good number. That is, again, could we get that lower? For sure. And obviously we are getting that lower, working on getting that lower, but fundamentally 240 cost per live qualified call is not bad. But then if that client, this particular client isn't, but then if that client then struggles to close those calls, the problem is sales, not the fact that the cost per qualified live call is too high. And I'm going to show you proof of this here in a minute when I show you our numbers for our own offer. I'm going to show you everything, and I think you'll be quite shocked. All right, so that's variation 1 though. Certain people are unable to close due to a lack of sales ability. Okay, and then in their mind, the VSL doesn't work. Or the second variation is the ads in the VSL is working. They are generating sales calls, but in the client's mind, all the calls are unqualified. And then when we do a sales call review for the client, it's clear that, again, the leads are qualified, but the sales call isn't good enough to get the close. So it's just not a great sales call. Now, in either scenario, the outcome is the same. You'll never be able to be able to have a scalable asset that continuously produces you new clients at will and ultimately drives you to $1 million a month and beyond. Not because the asset doesn't work, rather because you or your sales team couldn't close the leads. And that's what this really comes down to. And really, that's what eats away at me whenever I see this with a client. Because in either one of these scenarios, I know from experience, because I was there at one point. I was like, damn, our ads don't work, or ads in general don't work, our VSL doesn't work, etc. But then I realized our closers were closing at like 5 or 10%. It was really bad. And then I realized once we got those guys to 25%, which is again ideally the KPI, immediately we became profitable. And that's when we took our ad spend. I think at the time it was maybe 15, 20K a month, to now just last month, I think we did about 150K in ad spend. And it was just because the ads and whatnot stayed the same, but the closer ability increased. And yeah, I know at this point how close you truly are to having full control over the scale of your agency or coaching business if we just get these small twinks ironed out. So for context, just to put this again into perspective, if you spend 30K a month on ads and you take 100 live calls per month from that 30K a month spent, right? And let's say on top of that, you have a 12K offer for 4 months, and you are collecting 50% upfront on average. So per sale, you're making 6K, and then you have a 6K recurring payment in the back end to make the 12K total offer, right? Let's say that's your instance. Here's the impact that close rates has on your profitability and or scale. So for example, in example 1, we got close rate of 10%. Well, if again, you spent that 30K, you would get 10 closes, right? Because you have a 10% close rate. Now, in that instance, based on this offer math here, you would then collect 60K in cash collected. So you spend 30K, you collect cash collected 60K, which would obviously put your cash ROAS at 2x, which cash ROAS just basically refers to this month, how much did I spend? And this month, how much cash did I collect? That's not obviously then factoring in, if you sign a 2K a month client, but you only collected 2K from them this first month, and then next month's another 2K, the month after is another 2K. Well, cash collected is only 2K in that instance, but then your revenue or the contract value might be 8K because you did 2K per month for a 4-month minimum. So that put you at 8K contract value. But this month cash collected, you've only done 2K. Does that make sense? So that's what the cash ROAS refers to. How much total spend versus how much cash collected this month did you generate? So in this instance, it would be 2x cash ROAS, right? Okay. Is that good? Is that not good? Well, it's okay, but let's have a look at some other instances, right? So let's say, for example, you bump your close rate by 50% to 15% close rate, right? Well, then again, you would spend 30K, same instance. From that same 30K spent, you would now close 15 new clients as opposed to 10 because your close rate went from 10% to 15%. That would then put your cash collected at 90K, and your cash ROAS would go from 2x ROAS to 3x ROAS, just by increasing your close rate from 10% to 15%. Now, you're still below KPI in this instance. So what would happen if you got your close rate to, most of the time for most offers, the KPI close rate is going to be, the close rate KPI is going to be 25%. So what would happen in that instance? Well, again, 30K spent. Now you would close 25 clients, and your cash collected would be 150K, which then would put your cash ROAS at 5x. Again, from the same 30K spent, just by going from a 10% close rate to a 25% close rate, you go from 60K, well, as I say here, in this instance, you go from a 60K a month agency or coaching business to a 150K business, excluding accounts receivable, which means you retain a client. This is just purely based on new clients closed for that month. You would go from 60K a month to 150K a month, simply by increasing your close rate from 10% to 25%. And again, this is only from 30K a month ad spend. If we was to spend 90K with the same numbers from above, with a 10% close rate, you would collect 180K. And with a 25% close rate, you would collect 300K from the same ad spend, which is insane. This is why your sales ability is the make or break of any of the success of any VSL, provided you are getting the right people on the phones. And just as a quick side note, I want to make this clear. If you're getting on the phone with people who aren't in your niche, don't have the problem that you solve, and or don't have the money to pay you, like physically, not because again, some people can say, oh, this is expensive, but that is just an objection. Like, if I have 20K in my bank account and I'm looking at buying something for 1K, for example, I technically have the money, but that product for 1K is, if I don't see any value in that and I only see $200 worth of value in that 1K product, I'm going to say this is too expensive. And or I'm going to say, I don't have the money for that, because I don't have the money for a product that is charged at 1,000, but is in my mind is only worth $200, right? Even though I have, say, 20K or whatever, 100K in the bank account, I technically have the money, but not for that particular product at that particular price. So you do need to delineate between, is this just a sales objection, or do these leads actually not have the money? Like, I'm charging 5K a month, they only make 3K a month profit. Like, they physically cannot pay me. Okay, well then yes, that's a quality problem. And so again, I'm saying, if you're getting on the phones with people who are like that, don't have the money, don't have the problem that you solve, you help with lead generation and everyone you're speaking to is, needing help with recruiting or something, like they don't have the problem you solve, and they're just not in your niche. You only work with e-com companies and everyone you're speaking to is a manufacturing business, right? Not in your niche. Then that is 100% a marketing issue and quality issue. So I'm not saying here that you should overcome a lack of quality with increased sales ability. That's not what I'm saying, because increased sales ability is not going to make up for a lack of quality. I want to make that clear. And obviously the quality is entirely on us. We'll be getting you those qualified book calls. And what I'm referring to up here with this instance of, this VSL death trap almost that eats away at me, it's in the instances where obviously we are generating qualified sales calls and we can see, again, emotions aside, these guys are actually legit good, but they're not being closed. That's where it really becomes an issue, because then you're so close to cracking the code, but it's just the closing that's holding us back, right? And so, as I say down here, I'm not saying that if you get on the phone with a prospect, what I am saying is that if you do get on a phone with a prospect who's in your niche, has the problem you solve, and has the money, like the physical money to pay you, those people you should be closing at a minimum of 25%. And so again, if this is you, here's what I recommend. If you don't have a closer on your team who has closed cold traffic on your offer above KPI, then you as the founder need to take the first 2 weeks worth of calls, or essentially however long it takes to dial in a proven process. The biggest issue I see with founders and bringing on closers and building a successful sales team is the following. The founder thinks that they can just bring on a closer and then just give them a script or no script, worse yet, and then they just expect the closer to just figure it out, even though that particular offer that they're closing for has never been proven and dialed in on cold traffic before. If you've been closing referrals, you've been closing organic leads, you need to realize that cold traffic is an entirely different, obviously, context of leads. So it does require a different sales process to close cold traffic versus organic or referrals. Speak to anyone in the space, they'll tell you the exact same thing who has successfully closed cold traffic before. But guess what? You want to figure it out. And again, we'll be working one-on-one with you. I don't want you to think this is all on you, because it's not. But you need to figure out how to close those deals or those leads, because that's what's going to get you to 8 figures, period. There's no other way you can get to 8 figures in a quicker, more efficient and profitable way than cracking the code on cold traffic. And we'll crack the code on your marketing. We've got that covered. But on the sales front, we do need either that input from you. Again, if you're the one on the calls, and I recommend for you as the founder to be on the calls if you don't have a closer on your team who has closed cold traffic on your offer before. Or again, we'll be working one-on-one with your closer if you do have this person already on there. Hopefully this is making sense. Now, this also gives you, this is the other thing. This also gives you the ability to record your calls. If you take the first 2 weeks of worth of calls, from our ads, this then gives you the ability to record those calls and then use them as assets to train up your new or existing closers. Even if you have existing closers on your team, I still recommend you as the founder to be the one closing the first 2 weeks worth of calls, because again, your closer isn't going to be used to cold leads coming in. And what can often happen is the closer thinks these guys aren't closable because it's just a more difficult sale. But if you have proof, yes, they are closable. I've just closed 25% of them or 30% of them in the first 2 weeks. They are 100% closable. Here's what you need to do. You can then, obviously, you've got proof to show them that it's actually doable, right? You can show them, yes, you can do it. But also, you can just record those closes that you make, right? Which, by the way, is the easiest and best way to train new salespeople. Just get them to watch others successfully close on the offer that they're trying to sell. It's so easy. Whenever we bring on a new closer, I think we have about 40 or 50 past closes that we've just, different closes on the team have made on our offer. And then when we bring on a new closer, we just get that new closer to just watch those 40 or 50 closes. And then you can just see over and over and over again that number one, people are closing at the price point that we're selling at. And they can see the process or the framework to follow to be implementing on that ultimately gets the close. It's the easiest way to train new closers up. Now, here's the math to scaling any VSL. And I want to walk you through this more so from a point of just making you realize within reason how kind of easy it is to scale. I mean, again, you might think that's kind of crazy right now, but once I go through this, I think you will realize it's actually really achievable for you to be able to scale with a VSL specifically in the framework and process that we use and our philosophy around it. It's actually quite achievable, more achievable than I think you would be thinking right now. So the main metric that matters when scaling really any funnel, but particularly a VSL funnel, is the percent of ad spend on your P&L. Now you could have a cost per book call of $10, which sounds great. But if your marketing cost is 80% of the P&L, it doesn't matter. Meaning, every month you're doing 100 grand total revenue and you're spending 80K a month on ads. Well, yes, you have a $10 cost per book call, but fundamentally, who cares about the cost per book call when you're generating 100K a month and you're spending 80K a month on ads or 50K or whatever the number is. You're spending so much on ads that ultimately the business is not profitable. This goes back to what I was saying in one of the earlier videos. We are not just trying to get you sales calls. We're trying to scale your company. In order to scale your company, you have to be profitable. This is why the percent of ad spend on your P&L is the thing that you want to be making all of your decisions based on, not necessarily the cost per book call. And again, I'm going to show you proof of this in a minute. I'm going to show you what we do and our numbers, right? So conversely, on the flip side, if you have a cost per book call of $500, but your marketing cost is 10% of the P&L, then you can scale extremely aggressively. So if you was to look at our ad cost, I'm certain that you would be shocked at how expensive it quote looks. However, our ad spend rarely exceeds 23% of our P&L. And typically you don't want your ad spend to be higher than 25%. Ideally though, you want it to be about 20%. And as I told you earlier in the video, we've just recently aggressively scaled our ad spend. So we've kind of not bloated out, but usually we're about 17 to 20%, but right now we're about 23% because we've scaled our ad spend. But over the next couple of months, we'll dial that back. Anyway, in other words, when it comes to aggressively scaling any business, the main focus should be profitability. If your profitability isn't in KPI, again, in other words, less than 25% of the P&L, then you can look at the leading indicators to find the root problem. But ultimately, if your numbers are profitable and you're scaling, it doesn't matter what your cost per book call is. All right. And again, I'm going to show you proof of that here in a minute. So here's the only metrics that matter. Essentially, they're just profitability metrics. So number one is that the P&L, or on your P&L, your ad spend is 20 to 25%. So if you're lower than 20 to 25%, you should just spend more. If you can't spend more, then the reason why is your constraint, which you would need to alleviate to spend more. So for example, if you can't spend more because you don't have any more availability on your calendar, well, your constraint is you need a new closer. You need to make the hire and then go back to the ad spend and spend more. And again, we'll be working with you on this, so it's not on you, but just so you know how to think about it, right? Now, if you're significantly more than 20 to 25. And again, this refers to if you do 100K, you got 20 to 25K a month in ad spend. Well, if you're doing 100K and you're significantly more than that KPI of 20 to 25%, maybe you're spending 40K or 50K a month in ad spend to do 100K. If that's you, then usually it's because either, again, your close rates are below KPI. This is probably the most common, at least with our clients. Why? Because another reason why might be because your marketing costs are too high. But if we're running your ads, they're not going to be too high because we know how to do it, right? Sometimes with other agencies, or maybe if you're trying to run the ads yourself, this could be very well your problem is that your ad costs are too high. But because we're running them for you, your marketing will be dialed in. So if even once your marketing is dialed in, you're still unprofitable, then what the other potential problems might be is your close rates are below KPI of 25%, or your upfront cash and or your accounts receivables is low. So your upfront cash refers to, again, if you have a 10K or 20K product, how much of that on day one are you collecting? Are you collecting 5K? Well, then your upfront cash is 25%. If you're collecting 10K, then your upfront cash is 50%, right? And then your accounts receivable percentage is basically refers to, okay, if you have a 10K or a 20K product and you do a 4Pay on that, for example, how much are you actually collecting? Are you collecting a total 20K? Or are you collecting maybe 80% of the 20K, which might be, or 75% of the 20K, which then actually you're only collecting 15K, right? What's your accounts receivable, right? So they're the three things that you want to be focusing on, right? And really the P&L should be the main focus. This should be the number one thing that you're looking at. And if this is in KPI, don't worry about all this other stuff I'm about to get into because you can just scale because this is the ultimate metric that matters. But if this is not in KPI, then here's the three main metrics that predict the percent of ad spend on the P&L. So then obviously if this isn't in KPI, you can look at, okay, well, why isn't this in KPI? What are the three things that impact that? Well, then again, you can kind of look at these next three metrics here and then figure out what the problem is and solve for that. So the number one thing, or the first thing, these aren't in order, by the way, but the first thing is your upfront cash percentage. This should be 40 to 50%, meaning, again, you have a 20K product and you, on average, upfront are collecting 8 to 10K. That should be your KPI for that. Now, if you're below 40%, it usually means that you're being too soft/lenient on payment terms, or your closers are. So, for example, you pitched 20K for 4 months, for example, and and by the way, if you want more insight on this, watch the pricing to scale training. I talk about how to pitch and why you want to do, if you have a 5K a month agency service, but then, you wouldn't want to pitch on the sales calls 5K a month. Rather, you would want to pitch 20K for 4 months and then downsell to your payment terms of 5K a month if they wanted to do that, right? But again, usually if you're below 40%, it means that the closers or yourself, whoever's closing, is being too lenient on the payment terms. Meaning they pitch 20K, but then the prospect goes, oh, that's too much or whatever. And then you immediately jump to, okay, well, we could do 5K a month. And then everyone takes the 5K a month. Now you've got 25% upfront cash collection. When in reality, what you need to do is be a lot stronger, hold yourself at the end of the call. If they push back on price, you want to objection handle correctly, and then always loop back to the 20K pay in full, or maybe go down to a 2 pay, which might in that case be 10K over 2 payments, right? But not like just throw out the 5K 25% payment plan. You don't want to just throw that out. And a lot of the time, if you're below 40% upfront cash, it's because you're just throwing out the 4 pay or the max payment terms to get the close. But you don't want to do that. And we go deeper into this in the sales training as well. Now, if you're above 50%, though, the reason why this upfront cash collection KPI is not 40% plus, it's actually, you want it to be between 40 and 50, because if you're above 50, some clients come to us and they're like 70% upfront cash collected. That sounds great, but actually that means that your price point's too low and you should be increasing your price, because you don't want too many pay in fulls. Because, obviously it'll be good, but what that really means is that, again, your price point's way too low. Like we would get 100% pay in fulls if we was charging 1K a month. Like everyone would pay in full. If our project period was 4 months and we charged 5K for 4 months, we'd get 100% pay in fulls. But that's not good, because obviously, ultimately, we won't be as profitable as we can be. So even though our upfront cash collection is 100%, that's amazing. Oh my God. Well, actually, we need to increase price so that we're more profitable on the back end, right? So that's number one. The second reason why your P&L might be higher than 20 to 25% is because your cash ROAS is above. This is the KPI actually. The other reason why it might be because of your cash ROAS, and this you want it to be above 2x, right? That's the KPI for your cash ROAS, above 2x. So your cash ROAS determines how scalable you are on ads. So if you're at break even on day one, referring to cash collected versus ad spend, right? Which essentially means you spend 10K on ads, you collect 10K that month from those ads, right? So you break even. Well, you can't scale in that instance, because at scale, your efficiency always decreases. Meaning, in this example, you would be losing money. So if you spend 10K and you collect 10K, well, if you then take that 10K spend and turn it into a 50K spend, well, you're not going to break even at that point, because you're not going to maintain that one-to-one ratio, because whenever you scale spend, your return always decreases, right? So then you might spend 50K, but then collect 40K, right? So now you're losing money. And now that you're going to have there's a fuse on that for how long that's going to last until the business implodes, right? Being quite extreme there, right? But the idea holds true. Conversely, if you're putting $1 in and getting $2 out on day one, meaning you spend 10K in the month, and that month specifically you collect 20K cash collected, $1 in, $2 out, you can scale aggressively, because now you have, quote, client financed acquisition, which is a term that Hormozi basically coined, if you want to call it that. But that just basically means new clients are funding the business, as opposed to, going to investors and getting funding, outside funding. Well, now every time you're closing a client, because you're putting $1 in, getting $2 out, the clients are funding the business scale, because you're profitable on your acquisition, which in our space is kind of a lot of people expect, but in the broader business world, that is insane. Most businesses go negative on day one, but they can afford to, because they've got $100 million worth of funding from VCs or PE firms or whatever it might be. Whereas in our space, obviously most people don't have that outside funding. And so the only way you can fund the growth of the company is through client financed funding or client financed acquisition. And this is how you do it, all right? So that's that case. $1 in, $2 out, you can scale, because again, you've got that buffer, right? You're kind of hedging in a way. obviously on the flip side, if you're putting $1 in and getting $10 out, well, now you can scale extremely aggressively because you've got so much profit that if that $1 in, $10 out conversion, 10x conversion drops to maybe 7, well, you're still at, it's going to drop by 3x. Well, you're still at 7x return. So when you scale, that can go from 10 to 7 and you're still going to be massively profitable. Whereas if you're at 1 to 1, that can't move because if it drops, now you're at 0.8 to 1 and now, 0.8 to 1, now you're going to be losing money. So you've not got no wiggle room, which is why before you scale, you always want to make sure that you're profitable at the current scale because if at the current level, because if you go more, then obviously you're going to drop. And if you're not profitable right now, in the future, you're also not going to be. You're going to be, you're most likely going to be losing money. And a perfect example of this is at the point of writing this training, I had a call with a client that morning. And she told me that last month we spent 15K and she collected 300K in cash from 15K ad spend. I couldn't believe it. I was like, oh my gosh. And so obviously in that instance, she can scale extremely aggressively. Why? Because her P&L, ad spend on her P&L was 6%. Or I think it was even lower. It might have been 4% or something. It was something ridiculously low. And it should be 20 to 25%, which basically means she can just spend way more. She can just scale ad spend. And so that's what we're now doing, right? And actually, she couldn't handle, there's a couple of things on her fulfillment. So we're basically helping her hire for those few positions she needs to hire for. She needs to hire a manager for her account managers. We're helping her hire that. We're helping her structure the compensation structure for that manager. And then once she makes that hire, which I actually got a voice note from her today, she's making that tomorrow, that hire. And then from there, obviously now we have the ability to be able to spend more. And so we're just going to blow up her spend. And by extension, she's at 300K. We're going to, if we triple her spend roughly, that's probably going to be the thing that's going to get her to close to $1 million a month. So that's kind of cool. Anyway, aside from the point, the difference between cash ROAS and the P&L percent, right, of ad spend is that the P&L factors in accounts receivable, whereas the cash ROAS is only looking at new cash collected for the month versus ad spend. Hopefully that makes sense. So if this is, if your cash ROAS is 2x, is sub 2x, you're gonna have a really hard time scaling as everything, as I said before, becomes less efficient as you increase volume. So if you're sub 2x ROAS on day one, usually your upfront cash collected percent will be below KPI and or your close rate will be below KPI and or your ad costs will be too high. Again, this is very unlikely. I want to tell you like all the problems that could tie into one of these things being out of KPI, but in reality, this won't be your problem because again, if we're running your ads, you're not going to have this issue, but you may still have these two problems, which again is where you really need to use us and lean on us to get your upfront cash more profitable or higher, or just increase your close rate. And just quickly, obviously, it's pretty obvious why this might be low if your close rate sub, KPI. But how does your upfront cash impact this? Well, here's the thing: if you spend 10K on ads, right, and you close 5 deals, and of those 5 deals, you have a 10K product and you have a 25% upfront cash collection, which means 2.5K per close, and you close 5 clients. Easy numbers, right? Well, let's do 10. Obviously, if you collect 2.5K, that's going to be 25K cash collected for the month. If you spend 15K to get those 10 clients, well, you're going to be sub 2x cash ROAS. Does that make sense? However, if all you do is not increase close rate, not do anything else other than just take your 25% upfront cash collection of 2.5K on a 10K product to 50%, double it, well, obviously, guess what's then going to happen? You're going to then go from 25K cash collected from 15K ad spend to 50K cash collected from the same 15K ad spend, which then would take you from 25 divided by 15, a 1.6x cash ROAS to a 50 divided by 15, 3.3x cash ROAS. So that would immediately take you above the cash ROAS KPI of 2x. Does that make sense? Hopefully this is kind of tying in together in terms of how all of these other metrics tie into the ultimate profitability, which again, I'm going through all of this to show you how we need to, or how we essentially scale any one of these funnels to 8 figures plus, all right? And then finally here as well, obviously you always want your revenue ROAS to be more ideally than 5x. And this should be based on your LTV, not your contract value. Well, look, as I say here, you could do it based on your contract value if you wanted to be really conservative. However, I always base it on LTV. So what's the difference between these two things? Well, LTV refers to over the lifetime of a client or a customer, how much are you going to make from them? How much are they going to pay you? Whereas contract value means how much from the initial contract that they've signed are you contractually going to get, right? So for example, in our case, if we sign a client for 25K for 4 months, well, the contract value in that instance is 25K. Then obviously however much we collected on the sales call is going to determine our cash collection from that contract value. But over the 4 months, we know because of the contract, we're going to make 25K from that client. Okay, great. But that's not the LTV of that client, because what happens after the 4 months of that client finishing out that contract? Well, right now I think we have about 65-70% of our clients retain with us after their initial 4 months with us. So over the lifetime of that client, they may then start paying us whatever 50K a year, call it. Okay, well then if they stay with us for a year, the lifetime value, if they stay perfectly a year and that's it, well then the lifetime value from that client was 50K, but the initial contract value was 25K. Hopefully that's making sense. So that's just the difference. And so ideally you want to base your revenue ROAS off of lifetime value as opposed to contract value. This is what a lot of like e-com businesses and just businesses in general, when they look at their, they always base it on LTGP, lifetime gross profit, to CAC ratio. And that basically refers to lifetime value. All right. So if you have any type of agency or recurring monthly service, you shouldn't ever have a problem with your revenue ROAS being higher than 5x. Because, if you charge 2K a month, and you have, you should be having at least, if you charge 2K a month, I mean, you should have a average retention rate of that client for, I would say like more than 9 months, really, on a 2K a month price point, because that's super low. It's, you should be having more than 9 months. So in that instance, that would be 18K. Well, if you have an 18K lifetime value, to maintain 5X revenue ROAS, that would mean you would have to have a 3.6 CPA, 3.6 thousand CPA, which is really easy to do, especially on a 2K a month product or price point, right? So that's why it should be quite easy. However, if you don't have a 5X revenue ROAS, then usually the problems are fulfillment issues, and or you don't have a back end. So if you're a coach and you have a front end 10K product for 4 months, but then you're not selling your clients on anything after that 10K, well then if you add on a back end, you're going to make more per client, which is ultimately going to increase your LTV, which would obviously ultimately increase your revenue ROAS, right? So you don't have a back end. Obviously agencies, the back end typically is just recurring. Or your pricing is too low, which is typically less likely, but this can be common for $500 a month type services. Whereas if you're above 2.5K a month, then you're going to be fine on your pricing. So that's on your revenue ROAS. Now, again, the above metrics always take priority, meaning if your cost per click on the ads, for example, is out of KPI, but your profitability is in KPI, then you would want to spend more. However, if they are out of KPI, then below is the number one indicator, right? I put multiple here, but I only speak to one, which is cost per book call. This is going to be the number one thing that's going to determine all of these things here. But again, if these are in place, if your P&L is 20% the ad spend is 20% of your P&L, etc. Again, it kind of doesn't matter what your cost per book call is. I'm going to show you proof of that here in a minute. And yeah, by the way, this is why you'd be shocked at our ad metrics. Almost all of them are always out of quote KPI in the eyes of a media buyer, yet we continue to spend more and more and more. And it's because the metrics that take priority are all in KPI. So we're profitable. As I say, we rarely exceed 23% ad spend on our P&L, but yet our cost per click on our ads is typically like $15, which to a media buyer, $15 cost per click, oh my God, that's crazy. But it's like, yeah, but we're closing at 25%, we're doing this, we're doing that. We're actually above 25%, but you get the point. That's profitable. So who cares what the cost per click is? It really doesn't matter. But on the cost per call, this is entirely, just as a pre-frame here, this is entirely contextual to your business, price point, industry, service offering, and product. It massively ranges. We have some clients at $50 cost per call. We have other clients at $500 cost per call. And in each instance, it's both great. They're both scaling. They're both super profitable, etc. But because of their business, industry, price point, service offering, etc., that's why it's so different, right? And we also think about cost per book call very differently to how others do. And again, I want you to realize this is coming from a business owner's perspective, not a media buyer perspective. So these are our numbers, and I'll show you how this plays out in a minute. So let's say your price point is 20K for 4 months, right? Which is, in other words, 5K a month, and your upfront cash percentage collection is 40%. Or in other words, you make 8K cash collected per close on average. Obviously, 8K of 20K is 40%. So you have 40% upfront cash. Well, then in order to hit a 2x cash ROAS minimum on day one, right? Meaning ad spend versus cash collected in order for that to be 2x, you would need a 4K CPA because on average you make 8K per close in this example, okay? Which actually, interestingly enough, would give you a 5x revenue ROAS based on contract value despite lifetime value in this instance, because your CPA is 4K and the contract value in this instance would be 20K for 4 months, which would be 5x revenue ROAS based on the contract value. This is excluding LTV. So your LTV will be higher than your contract value. So if you hit a 5x ROAS based on contract value, then you're massively obviously in the clear. Now, this is where it gets fun and interesting, and I think this is where your eyes might open a little bit and be a little shocked, because I was when I first did this. And when I very first did this, I remember literally thinking I did the math wrong because of how much you can actually spend per call in order to scale. So if you had the close rate KPI of just 25%, not even 30, 35%, just 25%, in this instance, you would need a $1,000 cost per qualified live call, or at least that's the max that you could spend to get a cost per qualified live call. If you were closing at 25% and you had these numbers on your offer price point, upfront cash, etc. Now, if we had a 20% cancel rate based on the application answers, meaning book 100 calls and we cancel 20% of them, 20 of them, because on the application it's either a fake call or it's very clear that they're not in our niche. They're below, if for example, if someone books in a call with us, they say they're doing 0 a month with their agency, we're not going to close them, obviously. So we'd just cancel that, right? So you cancel 20% of the obvious unqualifieds, and then you also have a 60% show rate, right? That would mean your cost per qualified booked call KPI is $450. And again, just to show you the math again, how this all backs out, let me show you here. So if you had a $450 cost per qualified book call, this is just cost per booked call, right? Then you cancel 20% of them because they're unqualified. So then that would give you a $560 cost per qualified booked call. Then if you had a show rate of 60%, that would then equal a $930 cost per live call. Then on that the 60% who show, if you then close 25% of them, that would give you a $3,720 CPA. If we then collected 8K cash collected per close, because we had a 40% upfront cash collection, that would give you a 2.15, 2x, call it, cash ROAS, which is writing KPI. You put in $1 in, you get $1 out on day one. That's excluding the recurring. Then on that close, if you then had a 20K contract value, so you charge 20K for 4 months and you collected on average 8K, right? Because you have 40% cash collection, that would then give you a 5.37x revenue ROAS. Now, that revenue ROAS could be slightly lower if you factor in defaults and refunds, but just easy numbers, let's call it 5.37x revenue ROAS from a $450 cost per qualified book call upfront, or cost per book call upfront. These are actually our numbers. Now, obviously, our volume is much higher than, this is really our numbers, to be honest. Like, we spend a lot, so these are really good numbers at scale. Like, if we was to spend, say, 20K next month in ad spend, we would be getting a way better cost per book call. But as I said earlier, whenever you scale spend, efficiency always decreases, costs increase. So this is what we're at about 150 to 200K a month in ad spend right now. And so again, like when I first did these numbers, I was like, I couldn't believe how much you can actually spend on the front end and still maintain profitability. And again, this is max. I'm not saying here, this is obviously what your cost per call is going to be or whatever, but just to get you thinking. And obviously if your offer economics are different, so you're not charging 20K for 4 months, maybe you're charging 2K a month. And so for 4 months, that's going to be 8K. Well, then obviously these are going to be, you're going to need a lot lower cost per book call, which is fine. This is, again, just an example to show you the reality. And again, these are our numbers for our own offer. Like, we spend $450, oh, that's our max. We have 20% due to unqualified. We have about a 60%, 70. This ranges massively. Last month was 77% show rate. For October it was. Whereas, July, for example, I think was like 55%. July is a terrible month just every single year. So, this kind of ranges, but you get the point. And what I'm sure is that this is significantly higher than what you expected, but it shows you what you can spend up to. Again, this is not what we're shooting for. You don't want to shoot for your absolute max, but it does show you that, hey, I can actually spend up to that and still maintain profitability. And more importantly, still maintain profitability at a point where I can still scale aggressively because I am profitable and the numbers make sense, and we can still aggressively scale because we're still profitable. So then again, I'm sure again in this instance, it's clear how once you dial in the foundations, you can close at the 25%, you can get the 60% show rate in this instance, you can get all of these things locked in, you can charge 20K for 4 months, you can collect 40% or 8K per close upfront. Once you dial these things in, I'm sure it's now should be clearer to you in terms of how you can just scale, because then at that point, you just got to spend more. Just keep spending. You know what I mean? And again, we're going to be working with you on it, but again, hopefully this opens your eyes in terms of scalability. So in reality, as long as you're getting a sub 450 cost per call in this example, while it's maintaining those other KPIs, you essentially have an infinitely scale acquisition funnel because it's client financed until we hit your TAM, your total addressable market. But honestly, unless you're spending like $500 to $1 million a month, 500 grand to $1 million a month, most of the time, you're not going to even ever touch your TAM, never mind, completely saturated, right? As I said here, which takes a lot of scale. But even then, even if we hit your TAM, you then would just pivot to an adjacent market and go again and keep going. And that's how you scale, bottom line. So this is ultimately why the VSL funnel is the easiest and best funnel to use to get to 8 figures with any agency or coaching / consulting type business. It's by far the easiest. You try any other funnel, it is so difficult. Webinar funnels, Facebook group, like opt-in free lead magnet type funnels. Any of those is so difficult. Outbound funnels, if you're trying to do that, it's so difficult to scale. Whereas the VSL funnel, once you get, again, the foundations locked in, you can close at 25%, you can, got a good upfront cash collection, you can charge a decent amount. You've got, you can bring on a closer, they're doing the same numbers. You've got the back end to facilitate that scale. You can handle the volume on the back end from an account manager model or fulfillment type model, right? At that point, we just scale, we just push the volume, and that's it.